Just hang on. Right, sorry, I just haven't begun. I'm just setting a couple of things up. All right, hi everyone. Just want to make sure you guys can hear me loud and clear. And as well, you can see my slides as well. It should be showing IC Markets webinar, build your trading strategy. Right, we're still a little early, so let's just wait for a minute before we start. All right, thank you. Thank you, Ola. Ola Yiwola. All right, thank you. All right, so we can hear me loud and clear. You can see me as well. All right. So let's just hang on for a minute and then we can start. All right, okay, so as you guys know, today's webinar is about building your trading strategy, swing trading. Okay, so before we get into it, right, okay, so of course we have the disclaimer. Please take note that any information in this video does not contain and should not be construed as containing investment advice or an investment recommendation or an offer of or solicitation for the transactions in financial instruments. All information is presented as educational material only. Also, do take note of the risk warning that comes with trading CFDs. They are complex instruments that come with a high risk of losing money rapidly due to leverage. All right. Okay. So my name is Ketan Ramachandra. I'm an investment analyst here at Everest Fortune Group. So this webinar series is brought to you in a special partnership with IC Markets and Everest Fortune Group, where we have been the finalists for Best FX and Equity Research for the following years, 2019, 2020, and 2021. All right, so here's the agenda for today. So we're going to start off with the basics of what is swing trading, and then what are the typical swing trading indicators that are used, as well as some of the typical chart patterns. And then also how can we use fundamental data as catalysts, and which are the current data that's important, and also what are the examples of swing trading, right? Okay. Okay, so swing trading, okay, it's basically a strategy that attempts to capture short to medium term gains over a period of a few days to several weeks. Right, so this is very different from intraday trading or scalping strategies where you may hold a position just for a couple of minutes, or yeah, depending on what you're doing. If you're like doing really fine scalping, then it could be a holding period from a few minutes to 10-15 minutes, or could be longer, over a longer period as well, maybe 1 to 2 hours or 3 hours for an intraday trade as well. Okay, it is okay, and just like many other strategies, it is also a trading technique that uses technical analysis to identify potential entry, exit, and stop loss points based on significant highs and lows. In addition, because you're holding data or holding positions over a longer period of time, which can range from 1 or 2 days, 3 days, or going up to as high as 1 to 2 weeks, right? So you can also use fundamental analysis as an additional analysis tool to help support the trade idea or the trade position, right? So if you have incoming data or upcoming data that is contributing or acting as catalyst to your position, that's great. So you can use that to continue to holding your position, or perhaps even adding to your position as well. Hi Justin, you said the screen is not changing. Is it better now? Hi Jamilu, good to see you as well. Justin, just want to make sure that you can see that the slides are changing. Is it okay for you now? What about for everyone else? Just let me. Oops. All right. Okay. Okay, wait, hang on. Is this better now? All right, sorry, apologies. Let's start. Let's go from the start. Okay. So, okay, then, yeah, sorry, the screen was on pause. Yep, okay, I think this is better now. All right, okay, sorry. So as usual, okay, we'll start with the disclaimer. So any information in this video does not contain, it should not be construed as containing investment advice or an investment recommendation. All information is presented as education material only. Do take note of the risk warning that comes with CFDs, as they are complex instruments and come with a high risk of losing your money rapidly due to leverage. Okay, right, okay, so I just introduced myself as well earlier. So this is a webinar series is brought to you with a special partnership with Everest Fortune Group and IC Markets. And all right, and this is the agenda for today. Right, so what is swing trading? What are the typical swing trading indicators and chart patterns that we can use? How can we use fundamental data as well? And what are the examples of swing trading too? All right, okay, so this is where I left off, right? Okay, so yeah, so basically swing trading can range from a few days to several weeks. Um, it can be on any instrument, right? It could be a commodity, it could be a forex pair, or it could even be the indices as well, or even um, a particular stock as well, right? And because your holding period is longer, you can also use fundamental analysis or fundamental data to back up your trade ideas or your trade positions. So if you do see the upcoming data printing in such a way that it's actually acting as a catalyst to your position, it could be a long position or a short position, it actually gives you justification, further justification and further what's the word for it? Further conviction to continue to hold the trade based and use it together with your technical analysis as well. All right, okay. So naturally, with any trading strategy, there are pros and cons. So what are some of the pros and cons that comes with swing trading? Okay, one is, of course, swing trading requires less time to trade than day trading, because of course, as we all know, with day trading, we're actively trading during the day. So it could range depending on your trading style and strategy. It could be you could be trading 3 to 5 trades or putting on 3 to 5 trades every day, and you do need more time to spend on each trade as well. Okay, the other pros of it is, okay, besides because swing trading you require less time as you're holding positions over a few days or over a couple of weeks. This allows people who have like perhaps are more busy during the day, like with their day job, and do not have sufficient time to intraday trade. They can probably do it plan their strategies over the weekend, and then enter the markets during the day or maybe after work, depending on how you've done your analysis. So this might suit people who may not have so much additional time to put on intraday trades while they are working. All right, okay, so another positive take from swing trading is it maximize short-term profit potentially by capturing the bulk of market swings, because you're looking for larger moves. So based on TA or technical analysis or based on some fundamental catalyst, you are holding the position for longer, thereby potentially capturing a larger part of the move, right? And swing traders can also just rely exclusively on technical analysis, which is probably the same as intraday trading as well, right? Intraday trading, if you can just rely purely on TA as well. So, right, so it's kind of similar. Okay, what about the negative aspects of um, swing trading? Right, okay, so swing trading positions are subject to overnight and weekend market risks, right? So this means that, as we all know, on weekends, all the markets close, right? For all the commodities and all the exchanges are closed as well. Futures markets, stock markets, and the FX markets as well, they're all closed. So there is a risk of markets gapping up or down on the new trading day. So that's quite a risk as well. And also overnight as well, when some of the futures market reopen early in the morning, there can be gaps that may affect your position. So that's the risk that comes with holding swing trade positions overnight as well as over the weekend. And also, of course, abrupt market reversals can result in substantial losses. But of course, this has to be mitigated by putting in your stop loss levels as well, because it's all about TA. and risk management. If you are using TA to identify entry points and exit points, we should also be using it to identify your stop loss level and to have a robust risk management system in place as well. Right, and also, okay, swing traders often miss longer term trends in favor of short term market moves. This also depends on how long your holding period is, right? So if you're holding only just for a few days and the move is actually playing out over a week or longer, then yes, you would lose out in that sense. All right, okay, so what are the typical swing trading indicators to use and what are the chart patterns that we can usually see? All right, so typical indicators use moving averages, Bollinger Bands, stochastic oscillators, and relative strength index as well. So I'm sure many of you should be familiar with these indicators, so there's no need to go into real detail about each particular indicator. And similarly, I believe most of you should also be familiar with the more typical chart patterns that we can see. So let's see. Okay, so we have patterns such as wedges, pennants, triangles, and of course head and shoulders. So wedges, how can we use wedges? Right, so wedges are used to identify potential reversals. So for example, a falling wedge on a falling market or a rising wedge on a rising market. So what does that mean? Obviously a picture is easier. So this is the wedge. So you can see price trending down, and you can see this black line here. This is the falling wedge. So as price is falling within the wedge, and then it breaks out to the upside, and this is a we're looking for a bullish breakout. So because we have a falling wedge and price is trending lower, this is actually indicating a potential bullish breakout, and we're looking for this type of chart pattern for price to break out. So similarly, when you have a rising wedge, price is moving up, and you are expecting price to break out. So you're looking for it to break out of that lower slope and fall lower and drop lower. All right, pennants. Okay, pennants are leading to breakouts. This could be either to the upside or the downside. Right, they can occur when markets consolidates after a significant price move. So as you can see, pennants here, this is a pennant, right? So you can see price, in this case, in this example, price has pulled back very sharply and then is consolidating within the price range and is contracting, right? So you can see it contracting equally. So you can see the pennant being formed, and price could either break out to the upside or to the downside. All right, triangles. Triangles are seen as a precursor to a breakout if the pattern is invalid, right? So that means you're seeing it, like in this case, this is a ascending triangle. So price is testing the resistance several times and is actually making higher lows. So this would suggest that price is going to break through this resistance level and move higher, right? And the last one, of course, is head and shoulders, right? This chart pattern leads to bearish reversals, while the inverse head and shoulder leads to bullish reversals. So in this case, you can see price forming the left shoulder, then the head, then the right shoulder, and this is the neckline, right? So when you see this sort of patterns, you see the first shoulder, the head, and then when the second shoulder comes up, what we're looking for is price to break through the neckline and potentially see it drop further. So, and conversely, if you're looking for an inverse head and shoulder, you just have to imagine this is inverted, and then you're looking for the second shoulder for price to break through the neckline and move higher. Right, okay. Okay, using fundamental data as catalyst, as I said, fundamental data can be used to potentially continue your move, to provide further fuel for the continuation of the move, be it to the upside or to the downside. Recently, we've seen, right, or rather over the past year, we've seen a lot of inflation-related data pushing prices, acting as tailwinds for the US dollar, and recently it's been acting as a tailwind in terms of the dollar falling. right? So last year, throughout most of 2022, as inflation data was rising month after month, PPI data was also rising and energy costs was also rising. The US dollar was actually gaining in significant strength, as well as and also aided by central banks, which were especially the Fed, which was raising interest rates to combat inflation, right? So as the Fed was raising interest rates, inflation was still rising, and then the combination of these two uh, actions, I would say, or one action, so one central bank action and one data point was causing significant demand for the US dollar, which would then drive up the dollar index, and of course all the other pairs would react accordingly. Right, so similarly now what we are seeing is softer inflation data coming in month after month. Softer means that uh, it is coming in lower than the previous month's reading on an annualized basis, and so that's helping to accelerate or fuel the dollar sell-off, right? So when you see that, and also when you see central banks, well, the Fed, although they're still raising rates, but they are now coming up with a wait and see approach as well. So you can see markets have digested the fact that the Fed may not be so aggressive moving forward. So hence we are seeing the dollar sell off as we see inflation also coming down quite sharply, right? So we also have to take note of what central banks are doing, right, in terms of monetary policy actions. Are they hiking, cutting, or are they intervening in the open market, right? So for example, like the Bank of Japan actually intervened in the currency market last year of around October, right? Because the yen was getting devalued very significantly. But I think let's just switch over to the chart, because that'll be much more easier to explain. Right. Okay. So here I am on the dollar yen. This is a daily chart. So right. So I'm going to just zoom out. Okay, no, this is fine. Yeah. So this is 2022. So we can see yen hitting a high as 152, 153. Right. So the yen was being devalued significantly versus the US dollar. One of the primary reasons was because the Fed started raising rates aggressively starting in March, while however the Bank of Japan continued to keep its rates at negative 0.1%. So basically you had a case of monetary policy divergence where one central bank, in this case the Fed, was raising rates aggressively, while the Bank of Japan kept its rates at negative 0.1%. So when we came to this point here, an intervention measure was announced by the Bank of Japan, which caused dollar yen to peak at about 151, 152, or close to it, right? And then after that, it pulled back, consolidated, and gone down. So using that news event or that intervention action as a fundamental catalyst, we would have been able to try and identify potential short entry positions as well, right? So this is this is just one example of how we can use fundamental action or central bank actions to help us uh, identify trade entries, and also help us to continue to hold the trade as the data moves in our favor. All right, so examples of swing trading. So, okay, once again, we'll go back to the chart. Right, okay, so um, for this, okay, what I like to use is a combination of Bollinger Bands uh, and stochastic as well. So Bollinger, there's no change to the settings, just the typical settings, 20 for the length of the moving average using 2 standard deviations. And for stochastic, I generally prefer to use, okay, generally I use 20. Sorry, I like to use 20 for the length, and then 3, a value of 3 for the smoothing parameters, right? I find that that gives me, helps me to identify potential entries and exits, or oversold or overbought positions, oh sorry, overbought and oversold positions, together with Bollinger Bands as well. Of course, you can use other indicators that you're used to, right? It's what what's actually important is using technical indicators that you're familiar with, and to see how they complement each other and where it's actually helped you to identify potential or high potential entry points and exit points as well. All right, okay. So, right, okay, this is dollar yen. So what I'm going to start off with, I think I will start off with oil, right? Okay, one of the reasons for oil we can do is, right, okay, so also similarly for oil, there was a case where, okay, in 2022, we had oil prices rising, energy prices rising. And what happened was actually the US government had approved the release of oil barrels from its Strategic Petroleum Reserve, otherwise known as SPR. So when that happened, uh, the US government basically started flooding the markets with additional barrels of oil in an effort to bring down crude oil prices, which worked, right? So they released, I think, about 180 million barrels of oil over the course of the year, starting from like June of 2022. So because you have a major news event like that, so it's basically another fundamental data point or fundamental action taken by the US government in this case to increase the supply of oil in the open market. So this caused crude oil to pull back pretty sharply, right? So using a combination, using that data point and then using your stochastics and moving averages and Bollinger Bands, for example, you can identify potential entries, short positions, as well as reversals on the bounce as well. So like, for example, for oil, this is, I'm on a daily chart. What I like to, sorry, no, what happened? Ah, okay, sorry. So for oil, generally, what I've seen since most of last year and this year as well, especially on the daily chart, when we see a combination of the stochastics going below 20 and we see price pushing down on the lower Bollinger Band, typically it suggests that uh, price action or price that this instrument is oversold, and it potentially indicates a reversal in price as well. So we can see here on 23rd of June, price did bottom, and then on 24th is when it bounced higher as well. So of course, I mean, this is on a daily chart, but then I will zoom in onto the 4-hour chart to actually try and see how we can do it, and also try and see how can we relate this to where price is currently trading. But just to see how it generally works, how it generally worked in the past, was we can see here price pushing against the lower band of the lower bound of the Bollinger Band, breaking through it. We can also see stochastic going under 20, and then after that on 24th of June, as price started to move up through the lower bound of the Bollinger Band, we also see stochastic moving up and going higher. So if we go back to 23rd of June on the 4-hour chart, so we basically, where we go to use in this example, it's using the daily time frame to identify the potential reversal area or reversal moment, and then after that, of course, using a smaller, lower time frame to identify the entry points as well. So as you can see here on 24th, was it 24th? Oh, this is July, so sorry, 24th June. Right, okay, so similarly here, so we can see, if you remember on the daily chart, we saw the price move break out below the lower Bollinger Band. We saw stochastic also trading below 20 as well. So that would be signaling to us that, okay, it's time to look out for a potential entry or reversal entry. So then we can zoom in onto the 4-hour time frame. And then as we saw on 23rd, 24th, price had broken through the Bollinger Band with stochastic also going below 20, we would have identified, okay, so perhaps around this level. When you move into the H4 time zone, you can see the stochastic moving up above 20 as well, and you can also see price has formed essentially a double bottom here on 22nd of June and 23rd of June before going higher. So potentially we would have entered a position roughly around here, 23rd and 24th of June, roughly around here, which is about 103.25 to perhaps 104.50. And then because we can see the double bottom here, we can see the wick here. So in terms of placing your stop loss, we could have placed it probably just below this wick here on 22nd of June. And then as price moved higher, we can trail the stop loss. And then where do we take out the position, right? So as you can see on the 4-hour time frame, you can see stochastic moving above 80 as well. At the same time, we can also see price pushing up higher against the Bollinger Band as well. So we can never call the absolute top. So if you see stochastics generally break above 80, so probably around 109 or close to 110, where we would have been starting to at least take some of the at least start booking some of the profits, right? Maybe you take half the position out, and then you can let the rest ride, and then trail your stop loss as well. And also what's important is also we can see that the 20 moving average as well had sort of bottomed here and started rising up together with price as well. So this is how, for example, for oil, we can use the daily and the H4 time frame to identify potential entry points. And this was done on the bounce, or rather looking for a bullish reversal through to capture the reversal, right? Okay, and similarly on this same move, as we can see price being rejected off the upper Bollinger Band, and also we can see stochastics turning lower and going below 20. So potentially we could have said, okay, this move has been exhausted. So now as a potential entry point to the short side, I can probably say, okay, maybe I will look for price to break through the 20 MA, right, the 20 MA line, and probably place a trade entry at that level. And then we could use the stochastics, as the H4 stochastics broke below 20, and use that as a indicator to help us find the exit level or exit point for this short trade. And we can also see that price is also pushing against the lower bound of the Bollinger Band as well. So we have a combination of two indicators here to indicate potentially that this short move is now over. Right, so you can see this occurring for WTI oil multiple times. So even if you just keep on the H4 time frame, we are still able to use this technique or strategy as well. So you can see stochastics going below 20 on 30th of June as well, and price pushing higher. And then as price reverse from here, you could potentially take an entry as well, because you can see here on the 1st of July, stochastic bottom here on 1st of July, and then on the second candle onwards, 1st July, it started rising higher. So you could have potentially placed a long entry at this level around here, about probably 104.20 or 104.30, and keep the stop loss just below the recent lows here. Of course, price doesn't always go all the way up to the upper Bollinger Band, and stochastics indicators don't always go up to above 80, sorry. So that is why it's always important to have a stop loss in place, and not only to have the stop loss in place, but to trail it as price moves up, right? So now you can trail this either as an automated order in your trade entry, or you can just manually trade it, manually adjust it on a daily basis, for example, right? So as price moves up higher, what is obviously important is as it crosses or it comes close to the 20 MA or perhaps even higher, at least bring your stop loss back up to slightly above break even. So should there be any abrupt reversals, at least we will be able to exit the position with a small profit. Right, so you can see this here occurring quite a few times, although on H4 is a bit more messy. That is why I prefer to use the daily time frame first, right? Especially with 20 stochastic, especially with the stochastic dropping below 20, and using that as the potential flag to see reversal to the upside, and then zoom in onto the H4. Are there tools? Okay, that's Justin. Are there tools available for trailing stop? Okay, I'm not too sure what you mean by tools, but generally when you place the entry or open a trade order on IC markets, right, there would be an option to indicate and set up the trailing stop loss as well. Or otherwise, you can just, if you don't want to set a trailing stop loss, you can just put a manual, normal fixed stop loss, and then you can manually adjust it, perhaps every half a day, every 12 hours, or every day, and then as price, if price is moving up. Right, so this is how you can do it. Right, welcome, Justin. So yes, so as I was saying, it's perhaps better to use, at least on looking for potential bullish reversals, at least during this period. I would look on the daily time frame to see where stochastic has actually fallen below 20 and see if price is pushing beyond the lower bound of the Bollinger Band. And once I see that happening, then potentially, and then I would zoom in into the H4 time frame and try and identify entry points as well as a stop loss level as well. So you can see that over multiple times, whenever stochastic has dropped under 20, price is pushing below the lower bound of the Bollinger Band on the daily time frame. We have seen that this has usually led to a reversal in price action. Right. Of course, price didn't always hit the upper Bollinger Band, so that is why I said it's important to have a stop loss in place and use the H4 time frame to potentially identify exit points, right? So maybe on the not maybe, but most of the time on the H4 time frame, price would probably be pushing up against the upper Bollinger Band, indicating to you that okay, perhaps now it's time to take some profits for this position. And also in this here, we can see at least for the first part of the moves from July to August, price never really broke above the 20 moving average. So this would be probably indicating to you that if price was coming up close to this, I should be looking to exit or closing out this long bounce positions as well. And then you can use the H4 time frame to initiate potential shorts as well. Although you can see here the stochastic didn't come up all the way above 80, but if you were to look at the H4 time frame, the stochastic most likely most of the time would have come up close to 80 or above 80, and then would have started to come down. Right. Okay, so that brings us to where price is currently trading for WTI oil. So as we can see here, right? Okay, this is another instance where okay, this is very clear, right? We have stochastic breaking below 20, price pushing way beyond the lower Bollinger Band and then reversing to go back higher. In this case, we can see that the stochastic didn't drop below 20, but price was pushing lower. So this would be, I probably would have missed this trade, to be honest, because I would, at least on the daily time frame, I would have been looking for at least stochastic to drop below 20 to give me quite a significant confidence and conviction that there's a potential reversal occurring, right? So I like to see at least two indicators line up, right? I would like to see, at least personally for me, two indicators line up where we can see stochastic at least coming very close to 20 or maybe just slightly above it, and then we can see price ranging coming pushing beyond the lower bound of the Bollinger Band and then making the reversal up, right? So there can be many instances where the indicators don't line up exactly as what we had seen in the past. But yeah, it all depends on how you look at it. Like for me, I would really just like to look for the dual confirmation that price is pushing beyond the lower bound of the Bollinger Band, as well as stochastic coming very close to, if going below 20, if not coming very close to 20, to the 20 threshold, 20 level threshold. Right. So now in this case here, as we saw last week, we saw oil stage a pretty strong rally, WTI breaking above 74, 76, sorry, $76 per barrel. And then here we can see that, especially with this candle, when this candle broke down on the daily time frame, we could, and especially with stochastic going up as high as 97, right? So the last time stochastic went up high as 97 on the daily time frame, we did see price abruptly reverse. So like this is when we would be potentially signaling to us that, okay, we have a potential short short idea or short position to initiate for WTI oil. So similarly, this move here, price gapped up higher, and also if you I mean, as technical analysts or analysis with a keen eye, we also would have sort of figured that, okay, price is probably going to close this gap, right? Gaps are always there to be closed, whether it's to the upside or to the downside. So using the fact that, okay, we've seen a big gap up in price for WTI, we can also see that price is moving higher, going close towards the upper Bollinger Band, but not exactly pushing beyond it. But we do see stochastic at very elevated levels, right? So if you look in the past, it's all about relative action as well in the indicator. So you can see in the past, it's only gone as high as 91 here, and again about 85, 87, 85, 85.5. But here you can see it really going as high as 97. Plus we have a big gap here, and then of course as price started to pull back, especially with stochastic turning down, you could say, okay, it's time to initiate a short position on WTI with stop loss either just above this wick here, or perhaps just above where the body here, about 83, 84, 83 and 83.50. And then your first entry or the first exit point would probably be where the gap was exactly, right, at 75.60. So potentially you would be looking to at least close part of the position or the full position around this level as well. So this is how we can also use TA on noticing big gaps in price action to try and identify potential exits as well. So we can also see stochastic, at least on the daily time frame, falling sharply, and you could also say that, okay, fine, as price is coming close to the lower Bollinger Band, I could probably start looking to exit around 75 or $76 onwards and lower. Of course, price went on to make lower lows or new lows, but then, to be honest, if you had initiated a short around here at about 82 or $81, and then taking it out here at 6, that's almost like a 10% move, right? Yeah, sorry, 80, yeah, 82.7, yeah, so almost close to 8 to 10% move on a short position. That's actually pretty good. And if you break it down into pips as well, it would have been quite a significant gain in terms of dollar value as well. Right. Okay. Right. Okay. So let's see how we can relate this to where price is currently trading for WTI oil. So as I mentioned, stochastic pushing high as 97. Price is breaking above the upper Bollinger Band as well. This should have been signaling to us at least on 12th and 13th of July that potentially we have potential reversal coming up for WTI oil. So let's just zoom into the 4-hour time frame. And also, okay, you can also use Fibonacci as well, right? So for example, now that we I just use Bollinger Bands and stochastic as well, but we can also use Fibonacci as well. So in this case, like we have a nice move up here, right, from this swing low on 28th of June going to the swing high on 13th of July. So especially after this on 14th July when price started to pull back, we could have said, yeah, this is a potential swing high. And let's pull up all the fib levels, right? So we pull up all the fib levels, and then now let's just go into the H4 time frame. So potentially, if you're taking a short position at around 76.40 or $76, you could probably target the first Fibonacci retracement at 23.6% as the first level to take some profit as well, and probably the second area of profit you would probably be looking to take it at around the 38.2% Fibonacci retracement level. All right, now I'm going to switch over onto the 4-hour time frame. Right, okay, so let's just tidy this up a little bit. Okay, so we can see now on the H4 time frame as well, especially on 14th July here, price started to move, and then based on the daily time frame, right? Based on the daily time frame, indicating stochastic as being overbought, price pushing through the upper Bollinger Band. One way of initiating a trade is perhaps on the 4-hour time frame. You could see that, okay, if price breaks through the 20 moving average, there would be one potential entry point as well. Or if you see, if you would like to take the trade much earlier, you could probably enter about 76.50 as well and put your stop loss just above the swing high, right? It really depends on whether you want to get into the trade early or wait for some sort of confirmation, such as price breaking through the 20 moving average, right? So that it doesn't always occur. So for example, on here on 21st of June, if you're waiting for price to break through the 20 moving average, yes, this would have played out well. You could have placed your sell entry at the 20 moving average. You would have entered here, and you've at least been able to ride the profit down, ride the price down all the way to $69 per barrel. But however, in this case, for example, if you had waited for if you had set your sell entry where this 20 moving average is, this wouldn't have worked out profitably, right? You would have entered the position here, gone into a little bit of green over the next half a day or so, 12 hours or so before price reverse, right? So it really depends on your trading strategy and how you have identified it. But based on the daily time frame, especially for what we saw recently, especially with this sort of price action where you can see on a daily time frame price is pushing higher through the Bollinger Band, the upper bound of Bollinger Band. And what is equally important, or probably more important, is the relative strength of the stochastic here, right? So you've never seen it gone up as high as 96, 97 previously. And I'm sorry, the last time it happened was back in 14th of April, right? So when it comes up to here, it should already be signaling a potential reversal in price. So then you could just either, again, wait for it, either set your entry as price breaks through the moving average or take it much earlier as well. All right, okay, so this is for how we do it for oil. Let's see for what something else that works for me as well for swing trading is when I trade the US 500. So for example, for the US 500, I also like to, it's the same indicators, but because it's this instrument tracks the S&P 500, what I also like to use is also overlaid with the VIX, right? So what I'm going to do is I'm going to change this to the VIX, basically, which is the volatility index. So this tracks basically tracks the options pricing. Okay, I don't need Bollinger Bands for this. Right, okay, so everything's synced up. Okay, so I'm on daily time frame. So if you're trading the indices, for example, and especially the S&P 500, what I've also noticed over the past year or so was whenever the VIX rises above 30, it is also potentially signaling. Okay, hi Yudi. All right. You have a question about is the recording of this webinar? Yeah, sure. Go ahead. I mean, it will be up on IC Markets YouTube website, so it will usually get posted, I guess, in a couple of days or so. So, just do look out for it on the IC Markets YouTube page. So at least by the end of the week, it should be up there, right? So yeah, so do take note that any past recordings for any of the sessions will definitely be up on the YouTube page. Okay, so sorry, so where was I? Okay, so this was using the VIX together with Bollinger Bands and stochastics on the daily time frame to identify potential bottom. So this is more of a bullish reversal strategy that has worked quite well over the past year or so. So as volatility rises, the VIX rises as well. And naturally, when we see volatility rising, the equity markets are pulling back as well. So what has happened in the past and continues to do so, although volatility has been pretty low since middle of March. So what has usually happened around this period is when the VIX goes above 30 or comes close to very 30, it usually tends to signal a bottom in equity markets. And at the same time, we can also see the stochastics going below 20, and we also see, of course, price pushing beyond the lower bound of the Bollinger Band. So we have three indicators that help us to identify potential bullish reversals for the US 500, right? Okay, so what I'm going to do is I'm going to put a horizontal line, a horizontal ray, oh no, line. So I need it at, set it at 30. Right. Right, okay. So I'm just going to make this a bit smaller and right, okay. Trying to get more of the price chart as well. Okay, so as you can see throughout most of 2022, when the VIX went above 30, we also saw stochastic dropping under 20, and we can see price moving, pushing beyond the lower bound of the Bollinger Band. So this is potentially signaling to us for bullish reversal. So this is how we can use, or this is how I used it for the US 500 for putting on swing trades or bullish reversal swing trades, right? So then as you see these three indicators line up, then it should be indicating to you or flagging out to you that, all right, a potential reversal is coming up. And then you can, of course, zoom in onto the H4 time frame or H1 time frame and time your entry. Right, high Desiree, low VIX. Okay, no. Okay, when the VIX is low, it means that there's no volatility in markets, so there's no fear, right? So no fear when VIX is low, like what we are seeing now, it's below around 15 or trading around 14. That means there's very little volatility in equity markets, and usually that means equity markets are rising, but will continue to rise. When we see VIX moving up like this, if you can see my arrow here, my crosshairs here from 13th of January all the way up to 25th of Jan. So you can see VIX rising up pretty sharply. That's around the same time as we can see 13th of Jan. The index moving down sharply as well all the way till 25th, right? So VIX and the US 500 have a negative correlation or an inverse correlation. So that means that if you see volatility rising sharply, it's very likely that the US 500 and other major US equity indices are also falling as well during that same period. And when the VIX peaks and starts to retreat down, that's when equity markets tend to also bottom and move up. So this is how you can use this strategy for swing trading in US indices as well. Right. Okay. Welcome, Desiree. Okay. So we can see. Okay. Just quickly, just highlight some of the potential buy reversals or swing trading reversals for to the upside. So you can see this occurring here as well on 23rd of February. VIX going above 30, Bollinger pushing way beyond price pushing way beyond the lower bound of the Bollinger Band, while stochastics is also breaking under 20. And then around here as well. Of course, there are times where the strategy doesn't work out. This is one of the prime examples here on 28th February, where you see VIX rising above 30. You also see stochastics under 20 and price pushing beyond the lower bound of the Bollinger Band. Price did reverse. I'll just zoom in here, sorry. Where was I? What is it? 24th February? Yeah, price did reverse, but the move, there was no continuation of the move, right? So you do have to take note that this particular strategy is not a 100% guaranteed strategy, but it does help to identify potential bullish reversals for swing trading on I guess with a higher probability, right? At the end of the day, if we're looking for strategies and and a combination of indicators to identify potential high probability trades. That's only for the daily time frame. Okay, wait. All right, sorry, there's a question by UD. When VIX is above 30 and stochastics are oversold, why price tends to move up? Okay, so price tends to move up. I believe you're referring to price tends to move up after that happens, right? So because when VIX goes above 30 and stochastic goes under 20, what is signaling to you is a potential bottoming of the index, in this case the US 500, and we are likely to see a reversal, and that is why once the bottom in stochastic happens or stochastic goes below 20, you see VIX going above 30, that is signaling to us that potentially we have a bullish reversal coming up and is going higher. Okay, because this works well on the daily time frame for the US 500, because as we mentioned, swing trading usually lasts from a couple of days to a week or even longer. So that is why at least for me personally, I use the daily time frame to identify high probability bullish reversals, and then of course we can use the H4 time frame and perhaps even the H1 time frame to identify your entry points as well, or to fine tune your entry points, right? You use the H4 and H1 time frames for fine tuning your entry points. Right, so the most recent one, when we saw when price came close, or when VIX came close to 30, was around 14th of March, 15th of March. This was when we had the regional banking crisis in the US. We had SVB Bank, Silicon Valley Bank, as well as Signature Bank running into all sorts of trouble. So we saw equity VIX rising, coming close to 30. We also saw equity markets pull back, and we can see stochastic dropping below 20, price pushing below beyond the lower bound of the Bollinger Band as well, and VIX coming pretty close to 30 as well. It wasn't a sustained move above 30, but it came close to it, which would have been signaling to us that, okay, a potential bullish reversal is at hand, and we can use the H4 time frame and H1 time frame to fine tune the entry, right? So as stochastic started to move up, VIX started to recede. We can see, although yes, it was very choppy, pretty volatile, we see it moving up higher, the US 500 moving up higher as well. Yeah, so yeah, this maybe is not some for those who are intraday trading, right? Maybe swing trading over a day or two or a few days is a little bit different. So that is why, at least for me, I would use the daily time frame first with these indicators to identify potential bullish reversal in this case, and then use the H4 time frame to fine tune fine-tune the entries. All right, Desiree, there's a question. Vix, there's more. Okay, this question is right. Okay, generally when VIX is low, it is quite we don't know how low it can go, right? It is it I've not used this I guess looking at a low level of VIX to see how high price can go, for example, right? For this, potentially because we see price pushing up higher against the upper Bollinger Band, we see stochastic also above 80, VIX is dropping lower. To be honest, I in this position, and with indicators lined up like this, I wouldn't also use it for shorts. I mean, potentially it could signal to you that a short is happening, but generally I find that this combination of indicators works well for the bullish reversal. Okay, it works better on the bullish reversal, and with VIX being low, it means there's less volatility in the markets, and it could mean that S&P 500 or the US 500 could continue to rise further. Okay, because if we notice the US equity markets, especially the Nasdaq and S&P 500, and perhaps even the Dow, they generally move in the same direction at the same time. So you can also probably relate this, cross-relate this to the Nasdaq 100 as well. Right, so the Nasdaq, depending on the instrument, it's either the NAS 100 or Nasdaq. So if we put it here, so okay, so on the top chart, I have the Nasdaq, bottom is showing the VIX, and of course stochastic is here. So if we do cross-related to the Nasdaq as well and apply the same techniques and strategy, you can see that it works on the Nasdaq as well. So this would work for the US indices because the VIX is tracking the S&P 500. So you would use this for the S&P 500. In this case, this instrument is US 500, or you can also use it for the Nasdaq as well. And if you're trading ETFs, this would also work for the ETFs as well. Well, in particular, specifically the S&P 500 ETF, which is called the SPY. All right. Let's see if I can use it for swing trading for dollar yen. Okay, so obviously, if you're this VIX is for okay. Right. Okay. So this year we are on the dollar yen. So for dollar yen, okay, is this still coming? Sorry. Okay. Sorry. Apologies for that. All right. So okay, let's see if we can do it on the H4 time frame as well. Generally, I see that this usually okay for dollar for currencies. For me, what is it better on the daily? Yeah, again, I guess you could say that it works a bit better on the daily time frame to identify potential bullish reversals. And you can see here, dollar yen bottoming here on 2nd of December, also on 15th November. And recently here we could see that yes, okay, it does look like dollar yen could potentially bounce higher, but as of today, it is going a bit lower. For currencies here, oops, let me get rid of. So okay, so for example, for euro, again, at least to the looking for a bullish reversal here as well on the euro. So after we see price sort of bottom here over from 31st, 29th May to 7th of June, we see stochastic rising up, trying to move above 20. We also see price staying above the lower Bollinger Band. This would be potentially signaling a bullish reversal or swing trade to the upside. And then you could use it to use the stochastics to guide you to potentially take the exit at once, or identify potential exit points once stochastic comes very close to 80 and perhaps even beyond 80 as well. So as we can see in this strategy, when stochastics are moving higher, at least after the daily time frame, not always, is not a guarantee. As we can see, there can be abrupt reversals along the way, but usually when price is moving up through the 20-day moving average, we also see stochastic pushing higher after going below 20. Of course, we have price pushing close to the Bollinger Band, lower bound Bollinger Band, and then moving higher. Usually it does indicate a good reversal, bullish reversal for swing trade. All right. Okay. Okay. So I've come to the end of today's webinar. Right. I hope this has been a great session for all of you. I'm just going to launch a poll, so I'll really appreciate it if you can just give me your feedback as well. Right. Okay. So while we're waiting for the poll to take place, right. Okay. Let's just look at the Forex Factory calendar. So right. So I'm on GMT time. So I have the calendar from 17th July to 21st July. So today being 18th of July, we have Canadian inflation data coming up today at 12:30 p.m. GMT. So do look out for that. Inflation data, or Canadian inflation data, has been retreating pretty sharply. If we look at median CPI year over year, we look at trim CPI year over year, as well as common CPI year over year, all of these data points are retreating pretty sharply. So we can expect inflation in Canada to continue to come in lower. So that means that we might see a potential reversal in dollar CAD, right? So if inflation is slowing down, the Bank of Canada does not need to be so aggressive. So we could probably see US dollar gain against the Canadian dollar. So in this case, dollar CAD could perhaps push higher from here if the data suggests that inflation is retreating. Also, do take note, we have New Zealand data coming up at 10:45 p.m. GMT. Then we have UK inflation data at 6 a.m. tomorrow, 19th July, GMT 6 a.m. And then, of course, we have the Australia labor force report. Employment change, unemployment rate is basically the labor force survey that will be released on 20th July, 1:30 a.m. GMT. And also we have unemployment claims from the US at 12:30 p.m. GMT. So these are some of the key economic events to look out for this week, and will definitely have an impact on currency prices and also gold price as well. All right. Okay. Thank you everyone for tuning in to today's session, and do take note, look out for the recordings. All webinar recordings are eventually uploaded up to the YouTube page, so do search for it on the YouTube page. Usually it's up in about 2 to 3 days. All right. Thank you everyone. Take care and have a great trading week.